Okay, so it's official. The Fed is crashing the economy. Yes, it was another unbelievable week in the markets this week when the Fed announced on Wednesday that they were raising the Fed funds target another 75 basis points. The market proceeded to freak out, and he also indicated in his press conference and in the statement that they are serious about crushing inflation, and they are going to do basically whatever is necessary to bring down inflation to the 2% target. Okay, this seemed to have the effect of basically crushing everybody's hopes that the Fed was going to pivot. You know, this old line that's been going on for months where as soon as the economy softens, the Fed was going to pivot. He did whatever he could to squelch that kind of a view, and a lot of people were very surprised and shocked by it. So on this video, I'm going to go through a bunch of analysis on this and give you my views, and also show you a very amusing clip of Jeremy Siegel, who's a Wharton economist. He's a professor at Wharton, and he was basically losing it on CNBC today. I thought it was quite amusing. I thought the guy was going to have a stroke or something. But anyway, stay tuned because I'm going to be showing you that and going through a bunch of analysis. Okay, so it was again another very difficult week in the market, and everyone, of course, pays attention to the stock market, but the real devastation, and in my mind, the real story this week was in the bond market. Here is the 10-year Treasury for this week, and you can see it went from 345 to 368, 369. That is like a 24, 25 basis point sell-off, which represents a tremendous amount of lost value in the bond market. But the real devastation was in the shorter end of the curve. Here you can see the 2-year Treasury, where it went from basically 386 up to 420. That's over a 30 basis point rise, which for the short end of the curve, that is an absolutely tremendous sell-off in the bond market. Let's look at the 3-year Treasury. So the 3-year Treasury showed similar devastation. It went from a 382 yield all the way up to 421. And that's like a 37, 38 basis point difference. Tremendous devastation in the short end of the curve. The oil market had a similar sell-off due to economic fears, and you can see over here it got down below $80 a barrel for the first time since the beginning of the year. And really it has been just a brutal sell-off, considering the fact that just a few weeks ago it was selling for $97 a barrel. Now it's down to 79 and change. Quite a move. Okay, so what the Fed is doing, is causing a lot of dislocation in the financial markets. Okay, this is the Fed's intention. The Fed wants to raise interest rates and restrict credit in such a way that it slows down the economy. Now, I've said for a very long time on this channel that, and even last week, I was talking about the Fed is going to break something. And I think what came into focus this week very clearly for a lot of people is the thing that the Fed is going to break is the economy. And I think anyone who held out a hope of a soft landing, which I always thought was a complete fantasy, I think all of those ideas have been completely crushed, and people are now taking these Fed movements very, very seriously. One of the really interesting things that happened today on CNBC is they had an interview with Jeremy Siegel, who is a Wharton School economics professor. He's obviously a very bright guy. I don't agree with everything he says, but he does have a fair amount of credibility in the markets. but he came on CNBC and gave a diatribe about the Fed and basically lambasted the Fed. And I found it very interesting. I'm going to show you a couple of those clips right now. Here they are.
Professor Jeremy Siegel of the Wharton School. He joins us right now. Professor, it's good to see you again. What are your thoughts as we watch these lows of June at least be taken out from the Dow standpoint, and maybe in the days ahead we find the other major averages in this same precarious place?
Yeah, certainly. You know, Scott, I find it very amusing. A year ago at that September meeting, when we had booming commodity prices, when housing prices rising at the fastest rate in post-war history, when we had all commodities going up at rapid rates, Fed Chairman Powell and the Fed said, we don't see any inflation. We see no need to raise interest rates in 2022. Now, when all those very same commodities and asset prices are going down, he sees, stubborn inflation that requires the Fed to stay tight all the way through 2023. Makes absolutely no sense to me whatsoever. Way too tight. We do not have to get anywhere near that level to stop inflation, because all the inflation is basically stopped. I mean, you had a headline just came across 3 minutes ago, oil back to January levels. That's before Russia invaded Ukraine. You can see what's happening to commodities. We're going to get the Case-Shiller index next week. It's going to show no increase or a decrease for the first time in years. And that's a lagged indicator. On the ground, commodity, all the prices are going down. The only thing that's not going down is wages. And by the way, wages are in catch-up mode. Don't argue they're pushing inflation. They're lagging inflation. I mean, the workers are trying to get what a little bit back of what the inflation happens to be. I think the Fed is just way too tight. They're making exactly the same mistake on the other side that they made a year ago.
There are those who agree with you, who think that the Fed is oversteering.
Yeah,
but saying
absolutely.
But saying it doesn't do anything for the scenario that we're currently in. If they continue to do it, whether you think it's right or wrong, if they continue to do it, what does it mean for stocks?
Well, until he sees the light and says, you know what, I don't think we have to be so tight. Until that happens, you can still have pressure on stocks. I mean, and that's gonna, that's probably one of the factors that can see the light. I mean, when he sees how high real rates have gone, the dollar the highest in 20 or 30 years. By the way, next Tuesday we're going to get the monthly stock market money supply data, which is going to show the greatest decline in 5 months that we've had in the post-war period. I mean, if he looks at any of the monetary or financial indicators, he can't say, we have to keep them on. I mean, at his press conference, he said, we have to get real rates in the positive territory. They're in positive territory for every maturity. For the first time in years, we're already there. I thought that was the most uninformative. And no one was asking him a hard question. How do we have 3.2 million new workers and GDP going down? What does that mean? What does the record decline in the money supply mean? I mean, what does the collapse in commodity prices mean? What is the lag construction of these housing indicators that are 40% of the core inflation, which are going to filter through inflation for the next 12 to 15 months? Is that what he's looking at? Why is he looking at that? That's not an accurate view of what housing inflation is. I mean, there were no hard questions. There were 50 reporters there. I don't know. They basically said, repeat the statement you made at the beginning. There's so many things I ask him. What is he actually looking at? I mean, he's looking at 3-month annualized core inflation that is a lag. Well, we all look at market. I mean, look at what does the stock market do? It looks at market-oriented data. And that's what
Professor,
the Fed should be looking at.
I don't know that I've seen you this animated. You seem downright
I am very
angry
upset. Yes, I am. I'm afraid it's like a pendulum. They were way too easy, as I've told you and many others through 2020, 2021. And now, oh my God, we're going to be real tough guys until we crush the economy. I mean, that is just, to me, absolutely poor monetary policy would be an understatement.
Wow. I mean, I thought at some point he was going to have, a stroke or something there. But he did make some good points. He believes, as I do, that the Fed has been absolutely terrible over the last couple of years. And I've spoken extensively on that on this channel, how they did exactly the wrong thing at the end of the pandemic and kept the easy money policies too loose for too long. And it resulted, along with the reckless fiscal spending, this blowout inflation that we have now. And now we have to deal with these tremendous problems. So now he's arguing that the pendulum has swung the other way, and now the Fed is completely overreacting on the tightening side. Now, I don't completely agree with that. He's pointing to commodity prices weakening, and he's saying everything's weakening, okay? I don't know what he's looking at, but everything in my mind is not weakening. And again, if you just, as a practical matter, go to the store, fill your tank up. Okay, gas has come down a little bit, but it's still 50, 60% higher than when Biden took over. And many, many things are still extremely high, and in some cases still going up. And you're just now seeing the margin destruction with corporations, and you're just now seeing earnings start to come down. They haven't even fully come down yet. S&P earnings projections are still at 17, 18 times. They have to come way down from there to like 14 times, 15 times. Before you'll get anything close to a bottom in stock prices. But his excitement and emotions are reflective of what I think a lot of people are thinking right now. They're thinking, how can the Fed be doing this when for the last 20 years they were basically on an easy money policy binge. Now, as it relates to oil, we talk a lot about energy on this channel, and I just wanted to say a couple things about that. I saw an interview today with a guy that I follow, Francisco Blanch. He's the head oil and gas analyst at Bank of America. And he said that the one thing you got to look out for is oil substitution, meaning with everything that's going on in Europe, with the gas situation, with the Nord Stream pipeline being shut down and other gas constraints, there's going to be a move in the next year or so to oil as a substitution for gas in terms of electric generation. So that's going to increase demand. Also, he stated, I think correctly, that with the bringing down of the COVID restrictions, China is going to be ramping up their economy now, even though I think they're going to be in a continued recession. That is going to increase oil demand in the next, say, 6 months. So that's kind of a floor under the oil situation. And he also referred to the Iran deal that the Biden administration is continuing to try to push on the nuclear question. It looks like there's a very low probability that would succeed. But if it succeeded, that would put another 1,000,000 barrels per day potentially onto the market. And that could be, an influence for weakness in the market. But it seems like that's not going to go through. So he was pointing to that as a positive in terms of a floor under oil prices. So we'll have to wait and see what happens here. I still think that oil, while it's going to go up and down, it's going to be volatile, I still think that even in a worldwide recession, the oil situation will still be in supply-demand imbalance. the U.S. still has to refill its strategic oil reserves, which Biden depleted largely for political reasons before the midterm election, which is completely ridiculous, and everyone should be horrified over that. He will have to fill it up at some point because it's down to historically low levels, so that will add additional demand. One thing that I don't think people are really focusing on that I've been thinking a lot about is the strength of the dollar. The strength of the dollar has enormous ramifications all around the world, okay? And I think in addition to completely crushing every developing country's economy right now behind the strong dollar, you look at Europe and their energy crisis, okay? Now, the euro is at historic lows against the dollar. It broke below par, meaning below 1 to 1. Last time I checked, it was trading around 98 to the dollar, 0.98 rather to the dollar. And you got to understand, every time a European country or the European Union or Germany, whoever it is, wants to purchase oil on the world market, they have to convert their currency into dollars. Okay, it's called petrodollars. And this is a worldwide thing. So essentially, when your currency gets crushed because of the strength of the dollar, oil is going to cost that much more. And this is going to just exacerbate an already horrendous energy situation in Europe. Another thing that I think is a continuing threat to the world economy and also to the financial markets is the geopolitical situation with Russia. I mean, this thing is just deteriorating to the point where I'm getting very concerned about it. I mentioned on the last video that Putin has been threatening. At that point, it was indirectly. Now he has directly threatened to use potentially nuclear weapons in the Ukraine conflict because he's badly losing the war. Ukraine gained a major portion of the occupied territory, and I think that Putin is not going to allow himself to have a failure here, and he will go to great lengths to avoid that. And, you know, just the prospect of any kind of nuclear war, even if it's low grade, is just a horrifying concept. And just think about what that will do to the world economy and to the stock markets. Not that, you know, that's as important as the human toll, but it's just a horrifying concept. Just a few months ago would have been unimaginable. Now it's something that we have to consider and factor in. So I said on the last video, the Fed's going to break something. They're definitely going to break something. It may cause a black swan event, which nobody can anticipate what that will be. But for now, and for this week, it seems certain the thing that they're going to break first anyway is going to be the economy in the U.S. and, as a secondary thing, the worldwide economy. Okay, well, that's why I have to say this week, I hope that your portfolios were not too badly damaged this week and that you've been following some of the recommendations I've been saying on this channel. Raise cash on any rally, raise cash, stay liquid, only own the best names, nothing speculative. I'm still heavily weighted in oil and gas. And I have a couple of the blue chip, absolutely best names in the tech sector that I'm going to ride out through the further pain, which I believe is coming. I believe there's going to be a lot more volatility in the fall going into the election. I have this horrible feeling that all this pain that we've had is still in the relatively early stages. And you look at the VIX, it only went as high in the last couple of days as 31, which still really isn't that high. So I think there's more pain ahead. Stay liquid, stay positive, watch this channel, and we'll see you on the next video.